The next case we'll study is the case of a client who wanted to put a large down payment on a property. Matter of fact, they wanted to put the biggest down payment they possibly could because they were concerned about what their monthly mortgage note would be. Now, we've done full episodes on issues like, should I put 20% down on my mortgage? And I've shared that in most cases, my answer would be no. If you have a strong credit score and you can limit how much you're going to pay in PMI, and you don't know whether you're going to be in that home for longer than 7 to 10 years, I would say keep as much of your money in your pocket as possible so that it can be invested and have the opportunity to earn a rate of return instead of putting a big down payment down on a property. And then the only way you can get that money back is if you refinance it and take equity out of the property. Essentially, once you've put the down payment down, the only way that you can get it back is either selling the property or borrowing your own money back from the lender. But this client was really worried that if they didn't put the biggest down payment on their home possible, that they would have a monthly mortgage note that they couldn't afford or made them uncomfortable, and it would just stress them out. Now, one of the things that you want to consider in times like these is when you have mortgage rates that are slightly elevated. And that doesn't mean that they're like historically high. They're actually right in line with many times in our history. But there is the prediction from most analysts that at some point in time, the mortgage rates that you see now will go down 0.5%, maybe a full percent, and give you the opportunity to potentially refinance a property. Well, it would be one thing if you were buying a house now that you could barely afford and rates were in the 2.5% and 3% range, because then you really are over borrowing, and it's not like you're going to have the opportunity to see rates go much further down than 2.5%, 3%. But when you're getting rates that are 6.5%, 7%, and you know that analysts are predicting that at some point in time they're going to settle in the 6% or 5.5% range, you can reasonably expect that at some point down the line, there's going to be the opportunity to save 0.5% or 3/4 or even 1% on your home loan and give you some real savings on your monthly mortgage note. So what I talked to with this client is first, the benefit of getting multiple quotes on a home loan. Many people get one, maybe two quotes on a home loan, not understanding that the lending requirements, especially when you're talking about what we call non-conforming loans, can vary greatly from one company to the next. So we first talked to them about a 14-day period where we encourage them to get as many quotes from lenders as they can. 14 days because depending on the credit score that a lender is using to check your credit, you would have at least 14 days to check it with as many other entities as possible for that same purpose without it showing up as an additional inquiry on your credit report. So we mapped out a plan of action where in 14 days they would check their credit and get quotes from as many lenders as possible. And we made sure that we emphasized that the mortgages that they were looking into needed to have the ability to be recast. And I don't even remember if we've covered recasting a mortgage on this podcast. We'll likely do a full episode on it. But the premise of recasting a mortgage is if you are signing up for a 30-year mortgage, let's say it's $200,000 over 30 years, your lender's going to calculate a payment that's designed for you to pay the exact same amount every single month for 360 months. And at the end of that period of time, the balance of your mortgage should be $0. Well, the interesting thing about that is a big part of making sure that that monthly payment is the exact payment that's needed is the assumption that you're not making any lump sum or additional payments throughout the 30 years that would make your balance lower than they projected on that payment timeline. This is why when you do things like bi-weekly mortgage payments or making a mortgage payment at the end of the year, that it ends up paying off your mortgage years faster than you expected to pay it off. It's because that payment schedule assumed there was no additional payments. And when you make additional payments, it speeds up the timeline because you're making the same payment every month as well, but you're paying down a lower balance than they anticipated. Well, what recasting a mortgage does is it gives you the opportunity down the line, if your lender allows it, to make a big lump sum payment and recalculate the monthly payments that will be required for the remainder of the term to have your balance as $0. Going back to our example where we have a $200,000 mortgage payment for 30 years, let's say that our lender has calculated a $2,100 a month payment every single month to make sure that at the end of that period your balance is $0. Well, if 5 years into having that mortgage, you decide to make a lump sum payment of $15,000, you can ask your lender to recast your mortgage payment and say, hey, now I owe $15,000 less than you were expecting. I have 25 years left. What would it mean for me to change my monthly payment and still be able to have a $0 balance at the end of that period? And they may say instead of $2,100, you can now pay $1,900 for the remainder of the 25 years and still have a zero balance at the 360th month. Well, if you do that, you're essentially getting one of the bigger benefits of refinancing a property, which is the lower mortgage payment, without formally having to refinance it. So what we told this client was, hey, you are putting a big portion of your net worth down on this mortgage, and you can't get that money back unless you borrow it back and have to pay your lender at interest for money that was originally yours. So why don't we instead find your red line, the highest monthly mortgage payment with which you're comfortable, with the goal of keeping as much money in your pocket as possible instead of putting it towards the down payment. But now when we're looking for mortgage quotes, we can ask them intentionally, do you allow for a recasting of your mortgage? And if it doesn't, we can take them off our list and we can whittle it down to several quotes from lenders who will allow you to recast your mortgage. And that will give you two different opportunities to lower your payment. Either mortgage rates will go down as much as we expect and you can simply refinance your property and get the lower payment that you wanted on the front end. Or if you do it our way and 2-3 years down the line, you don't feel comfortable and you do want a lower mortgage payment, even if it means giving up your assets, you can simply give up your assets at that time and recast your mortgage for that lower payment. So it's essentially buying time for us to see whether the market will take care of their concerns or if they have more comfortability than they expected with a higher mortgage payment. And in either scenario, it would allow them to keep more of their money invested than putting down a large down payment.